I can't see Powell hiking rates at all, even though he should. But he may not cut. But that's not bullish for the dollar, because if inflation keeps getting worse, and so instead of 2 or 3% inflation that people were expecting, we get 5 or 6 or 7% inflation, and the Fed just keeps rates where they are, that means a huge reduction in real rates. And that is very negative for the dollar, and that is very bullish for gold. And traders just haven't connected the dots yet. I still think that I've got this thing handicapped correctly, that we're going to see an explosion in the price of gold and silver.
The reality of President-elect Donald Trump's election victory on a platform of aggressive tariffs and deportation of some immigrants landed hard at the Federal Reserve's meeting last month, with U.S. central bank officials raising new inflation concerns and staff suggesting the incoming administration's plans may slow economic growth and raise unemployment. The Asia Times Global Risk-Reward Monitor predicts that gold could reach $10,000 per ounce by 2030 if nations adopt it as a trade settlement mechanism. This scenario highlights the potential for a seismic shift in the global financial system, where gold replaces the dollar as the foundation of international trade. Gold ascent reflects a global loss of faith in fiat currencies, particularly the dollar, as governments and central banks turn to gold to hedge against economic and geopolitical risks. Renowned for his economic predictions, PeterSchiff expects that hotter-than-expected inflation has reduced the likelihood of rate cuts, causing gold to pare gains while closing higher. He notes the dollar's rally, driven by rising bond yields, is temporary and unsustainable. Schiff argues inflation will worsen, leading to negative real rates, which are bearish for the dollar and bullish for gold. Minutes from the Federal Reserve's December 17th and 18th meeting revealed officials expect inflation to ease this year, but acknowledge the risk of stubborn price pressures, particularly as they assess the potential impact of Trump's policies. During the 1970s, when the United States experienced significant inflation, gold demonstrated its potential as an inflation hedge. As the consumer price index rose dramatically, gold prices surged from $35 per ounce in 1971 to over $850 by 1980. This period was a powerful example of gold's ability to preserve wealth during monetary instability. From a technical standpoint, Schiff argues that traders misinterpret rising inflation as bullish for the dollar, asserting it signals the Fed has lost the fight against inflation. He predicts inflation will worsen, with the Fed unlikely to raise rates, leading to deeply negative real rates. Now we present the clips of PeterSchiff's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Look at the budget deficits. The national debt is now above $36.3 trillion. That means that we've added $8.5 trillion so far in Biden's 4 years of office. $8.5 trillion, over $8.5 trillion. That shattered Donald Trump's record for the most debt in any one presidential term. But what's even more, maybe amazing, horrifying, shocking, or probably better words, Barack Obama, of any president, and of course Joe Biden was vice president for the entire 8 years that Obama was president. So you can hang some of the Obama deficits around Biden's neck. He ran up $8.6 billion in debt in 4 years. Biden has done 8.5. Obama did 8.6 in 8 years. Biden has done 8.5 in 4. But by the time Biden leaves office, he will have broken that record. More debt than Obama did in 8. Now, unfortunately, I think if you add the increase in national debt, that's going to happen during the 4 years of Trump. If you add Trump's second term to his first term, he will beat Biden. He will beat Obama. So he's got the record, but he's not going to hold it for long because Trump is going to take it. Now, these are not records that you want, but these are records, unfortunately, that we're going to get. The national debt is going to be growing at least $3 trillion a year while Trump is president. That's $12 trillion in debt in the next 4 years. That'd take the national debt up to about $48 trillion. I think there's a good chance we're going to hit $50 trillion during the next 4 years. But if you understand where inflation comes from, and even with all the Republicans talking about it, Elon Musk posting about it, that inflation is the result of government spending, and specifically deficit spending, and you look at all the deficit spending that is coming, that is going to be even greater than the deficit spending we already had. And, a lot of people will say, well, a lot of it was COVID. It wasn't just COVID. I mean, we haven't had a COVID problem in a couple of years. And look at what we're spending. You know, Donald Trump's last there's no more COVID. And the budget deficits are almost 3 times as big as they were pre-COVID. That's how much government has expanded since COVID. But I guarantee you, if it's not a pandemic, some other emergency is going to rear its head during Trump's term that is going to justify in their minds another huge increase in deficit spending, right? Because the government feels that there's no problem that can't be solved by deficit spending, because that's been the solution to every problem. So there will be some kind of emergency, whatever it is, right? Whether it's another pandemic or something else, maybe even a fake alien invasion, who knows? But something is going to happen. They're going to say, we need more government. Government has to come and spend. And so the deficits are going to be during the next 4 years. And even if nothing happens, results in a big surge in deficits, we're not going to cut back from where we are. That never happens. The deficits just keep going up. And the reason is because the cost of ending them is too great. The only way we can actually bring inflation back down to 2% is to burst the stock market bubble.
In his analysis, PeterSchiff emphasizes rising bond yields, with the 30-year Treasury surpassing 4.9%. He warns that surging commodity prices signal worsening inflation and criticizes the media for ignoring these key indicators. Regarding the depletion of the Strategic Petroleum Reserve, Schiff argues it failed to encourage drilling at $74 per barrel. He highlights spiking inflation indicators and warns that optimism about economic improvements under a potential Trump presidency may quickly fade. Crude oil prices rose to a 3-week high amid mounting concerns over supply disruptions and increasing demands. However, technical analysts caution that oil markets may be overbought. Mounting concerns over limited supply from Iran and Russia buoyed crude futures prices recently. The Biden administration plans to impose more sanctions on Russia's oil exports ahead of Donald Trump's inauguration on the 20th of January. The outgoing U.S. administration will target tankers hauling Russian crude products priced above the $60 per barrel price cap that the U.S. and its European allies have imposed. Meanwhile, Trump is expected to reinforce restrictions on Iran's oil exports upon taking office, potentially causing a supply disruption of up to 1 million barrels per day, approximately 1% of global supply. Let's get back to the interview.
So these are the highest yields that we've had since the Fed started cutting rates. In fact, you have to go back even further than that. But again, this does not surprise me. This is exactly what I was saying was going to happen even before the Fed started cutting. But I said that when the Fed did cut, that would be market ended in 2020, with the COVID, blow off top in bonds and bottom in yields. But we are moving substantially higher. Mortgage rates now are back above 7% and rising. They're going to be above 8% pretty soon for a 30-year fixed rate mortgage. But they're back above 7. Credit card rates are 25%. They're going to keep going up. Now, we got more bad news. Forget about the fact that the mainstream media is ignoring boom in commodity prices. Which is completely inconsistent with the story the Fed is trying to sell. How can they be telling us that inflation is going to come down when prices are soaring? And these commodities, these are input costs. So they're going to bleed in to producer prices and consumer prices, right? They're going to move first. And then you're going to see it going, up the chain. So these are leading indicators. So how could you ignore? The last time we started to see commodity prices surging like this, it was before inflation really ran away. And then in the face of it, the Fed was still claiming that inflation was transitory, even though commodity prices were showing that that wasn't the case. Well, that's happening again. Now they're saying inflation's gone and commodities are surging or will cause the inflation. They are the result of the inflation that is already there. The Fed never put out the entire time. And now you're seeing it in these commodity prices. The dollar, which was down this morning, and actually had a big pop yesterday, the dollar rallied. I'll get into that after the break on why the dollar rallied. But the dollar sold off as soon as this hotter than expected inflation numbers came out. But it's not just the inflation numbers themselves that caused the dollar to rally, but it was the reaction in the bond market where the bonds were hitting new lows for the year on this news, and that increase in bond yields is propping up the dollar. But that's not good for the dollar. The currency traders still don't get they're still of the opinion that hotter than expected inflation,
Gold's impressive gains in 2024 and its continued rise in 2025 are not isolated events. They signal broader shifts in the global financial order. As nations and investors increasingly turn to gold, the dollar's dominance faces unprecedented challenges. How will rising inflation, geopolitical tensions, and de-dollarization trends reshape the global financial system, and can gold truly emerge as the foundation for international trade? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.